My name is Ewan McGahey, and we are doing in Enterprise Law today investment and shareholding. And what I'd like to talk about, or start to talk about, is two quotes and some historical charts on how shareholding has changed over the 20th century. Beginning with this quote, this is A.A. Burley, speechwriter to Franklin Delano Roosevelt, corporate lawyer who worked on the Versailles Peace Treaty, and this is one of the last articles that he wrote after having been a New Dealer, working at Columbia University, Property Production and Revolution in 1965. So he'd seen the growth in American prosperity, driven by collective bargaining, growth in workers' wages, and now more people were saving in the stock market than ever before. Before the Wall Street crash, it had been directly in shares, but particularly in the post-war period, there was the growth of institutional investment, particularly through pension funds. So he says here, one would expect that the law would increasingly encourage a wider distribution of stocks, whether through tax policy or some other device. It would encourage pension trust or social security trust entry into the stockholder position, as social security and pension trusts increasingly cover the entire working population of the United States. The stockholder position, though having lost its ancient justification, could become a vehicle for rationalized wealth distribution, corresponding to and serving the American ideal of a just civilization. And what he's referring to there with the stockholder position having lost its ancient justification goes back to his famous book with Gardner Means in 1932, The Modern Corporation and Private Property, which said that because in a company, those who control a company, the directors, are separated from those who own shares, the profit motive that was attached to private property does not work anymore. If you own property and you worked on it, then you would get the benefits of property. So that was the original justification for private property motivating production. But with the separation of ownership and control in a company, directors can profit from their office, not by doing good work, and shareholders don't do any work in order to get returns on their capital. They have passive property. They don't need to do any work to get a reward. And so that means that the traditional logic that Burley is referring to here, the ancient justification for property, has completely disappeared. And he says in this article that there was a further separation now with institutional investment. So you had not just directors in control of companies being separated from shareholders, but if shareholders were also institutions, many corporations, then they were separated again from the beneficiaries, the real investors in companies. There was a separation of ownership that was beneficial ownership from legal ownership of shares from those in control. And that means that Burl was searching around for another justification for why shareholding could be legitimate in a modern economy. And he says, well, if we have tax policy to make sure that everybody shares in a fragment of the wealth being generated by the stock market, then shareholding could become a way to have a more rationalized system of wealth distribution. Okay, so that was the big idea in 1965. And when we look at a chart of what was happening in American share ownership, we can see that there were significant causes for optimism if the way that the law was shaped was going to be in the interests of most people who save and work for a living. So this chart shows US share ownership from 1945 up until 2020. And you can see in the y-axis, it goes from 0 to 100%, like what percentage of the stock market is owned by these different types of actor. So the blue line that is falling and falling and falling is US households. So basically individuals who buy stocks directly from their Main Street bank. And what you can see from 1965 particularly is the green line breaking away from lots of others. And the green line is private pension pension funds. So that was Americans saving for retirement through occupational pension plans, largely because in the New Deal you had a growth of trade unions, and trade unions collectively bargained for better pensions at work on top of the minimum levels set by the Social Security Act that you got in America from government Social Security. So that was a minimum level, but you needed more. You had ideally a union that collectively negotiated a better pension plan. But what happened in 1986 is the Reagan administration introduced a package of reforms that incentivized a big shift from collective pension plans into individual accounts, notably 401ks, which come up on the orange line that you can see rising, which is mutual funds. So there was this idea that everybody could share in a fragment of the wealth being generated by the stock market. But this wasn't really happening because from the 80s, there were more, people's wages started to stagnate for one thing. Unions lost their power. Less money went into pension plans, and the Reagan administration pushed individualization of pension accounts. So instead of having big organized funds, you had more and more individual accounts, and they encouraged a huge amount of outsourcing. Although this really started under the Employee Retirement Income Security Act of 1974. So even the big funds were encouraged to outsource asset management services to specialist asset managers, mostly located on Wall Street. And so the relative share of pension fund money, big organized pension plans, declines. Nevertheless, what you still see today is this ongoing shift from individually held capital to institutionally held capital. And you can see pretty much the same thing happens in the UK, or you can tell a very similar story. So the blue line again in the UK shows individual share ownership declining. The green line shows the rise of pension fund capital invested in the stock market. But with the election of Margaret Thatcher in 1979, you have a number of pieces of legislation that we're going to talk about, which encourage more individualization of pension funds and outsourcing of investment management to specialist asset managers. The red line at the end, by the way, is globalization. So more and more money from abroad is invested in UK stock markets. That's not necessarily changing who owns, because the Office for National Statistics doesn't keep an account of where the money from the rest of the world is coming from, but it's basically North American, so United States and Canadian pension plans, mutual funds, insurance companies, just like we saw with similar makeup from the last chart, and then also money from continental Europe investing in the UK. And that accounts for about 90% of what shows up here as the rest of the world. But so, same basic story in the UK. Pension fund capital grows through collective bargaining. And that comes from better wages, so people have more money to invest in better pensions. But then from 1979, 1980, the law incentivizes more individualized savings and the outsourcing of investment to asset management. So relative to other kinds of savings, you can see the private pension fund share at the end as we get towards the global financial crisis, going underneath the amount of money that is invested in the stock market by insurance companies, and also getting down to the same level or a similar level to individuals again. Whereas the trajectory had been up. And you could have imagined that workers' capital saved in pensions would pretty soon have been a majority of the UK stock market. Okay, so the second quote that I wanted to give you is what's happened with asset managers, and this is particularly related to outsourcing. So this quote comes from Bernie Sanders, somebody who modeled himself on Franklin Delano Roosevelt, who Bernie wrote speeches for in his campaign for president in 2019. So his platform on corporate accountability and democracy said the following: today in America, a tiny group of asset managers control most of the votes in the economy. They control shares in corporations, which control our workplaces, our pay, our security and retirement, and our environment. The three biggest asset manager firms in America, BlackRock, State Street and Vanguard, if combined, would be the largest shareholder in 438 out of the S&P 500 corporations. So those are the big listed corporations on Wall Street and the other stock markets in the US. These asset managers oppose labor unions and fair wages. They support escalating pay for billionaire CEOs. They oppose meaningful action to end climate damage. The voting power asset managers control comes from other people's money. It doesn't belong to them, it belongs to us. And Sanders goes on to propose a number of reforms like making sure that pension funds are organised more democratically, broadly speaking, and that asset managers are under the control of elected representatives from pension funds. That quote is important because it does pretty accurately describe the situation that we've got today, except that this was 2019 and we're now in 2025, and the concentration of voting power amongst institutional investors, as we're going to see, has become even more extreme. I guess it's also useful to just take a quick look at what is happening in international standards before we get into the nitty-gritty of UK and a bit of EU law. And there's not much there, but the main thing is called the UN Principles of Responsible Investment. So what kind of duties do these enormous financial institutions have, or should they have, according to the United Nations? And there's 6 principles. It was drafted in 2006, so nearly 2 decades ago. It's pretty behind the times. It says we will incorporate ESG issues, so that's environmental, social and governance issues, into investment analysis and decision making. If you're a responsible investor, you're meant to be an active owner, so that implies using your voting rights, seeking appropriate disclosure on environmental, social and governance issues from companies where money is invested, promoting acceptance of these principles, working together to enhance implementing the principles, and reporting on activities. That's what's going on in international law, but it's way behind where the political debates are in countries like the US and the UK, where the problems seem much, much bigger. And basically, the call is for all of this power to be brought or to be subjected to some kind of responsibility, some kind of accountability to the people who really invest, because asset managers are taking and using other people's money. Okay, so what we're going to go through is an analysis through the lens of the law and the economy of the main players in institutional shareholding. So we're going to look at the finance and governance of the following actors: the Financial Conduct Authority, which is the regulator, the big asset managers, and then where the big asset managers are getting their money, namely pension funds, life insurance funds, mutual funds, and we're going to say a little bit about retail shareholders, who, of course, are a declining proportion, but might be coming back in a big way because of new fintech apps. Before we get into that, it's useful to just look at a typical investment chain. Where we begin with, the stock market is somebody, a real human being, having money to save, usually for retirement. Maybe you're investing in stocks and shares because you've got extra savings, but that's not most people. The vast majority of people who are invested in the stock market, and that is usually a majority of the population in a wealthy democracy, the vast majority of people are investing in the stock market through a pension fund or some other vehicle for retirement savings. So this is a typical chain. On the left-hand side is an example from the United Kingdom. Imagine there's me or any other academic. We work at a university and we save into a pension fund called the University Superannuation Scheme. It could be anything. It could be Railpen if we're working for a railway. It could be the local government pension scheme if you're working for your local council. It could be If you're working at the post office, there's a fund called Hermes. So there's lots and lots of different funds. Almost everyone who has a job will have some kind of fund. In fact, a third of workers in the UK invest in through what's called Nest, which we're going to get onto a public option savings vehicle. But the pension fund, even if it's the biggest one, like USS in this example, biggest in the UK, even those big funds don't do all the investment work. They almost all outsource to an even bigger asset manager. BlackRock is one of the biggest. Big pension funds might invest through multiple asset managers, but money goes from a real person saving for retirement to a fund, and then usually there's outsourcing of specialist investment management to an asset manager. They pass money on to what is known as a custodian, which does the technical work of registering shares through, in the UK, a system called CREST, a certificateless registry for shares, and then the money finally goes into a company like AstraZeneca. JP Morgan, by the way, does custodian or nominee services. Over in America, just on the right-hand side, same thing, just a few different names. The university scheme there is called TIA, but is the same big institutional asset managers like BlackRock. JP Morgan is also a dominant player in the custodian market. And then we've got an American company, Apple. So that is a typical investment chain. It might be not a pension fund, but a life insurance company or a mutual fund. But further down the chain, and the asset manager might be a bank or a broker. But further down the chain, it's pretty similar, whatever sort of name of different kind of fund you have. So that is how asset management chains work. And the regulator that oversees all of this in the UK is called the Financial Conduct Authority. This is set up under the Financial Services and Markets Act 2000. Sections 1C to G say that they have operational objectives of protecting consumers of financial services, so usually somebody, in our case, saving for retirement. The FCA does much more than this, but they're the regulator of these kind of financial services as well. They've got to ensure the integrity of the UK financial system, promote effective competition, and they've got a strategic objective of ensuring that relevant markets function well. Okay, so very high level goals, but the main way that they do their job is trying to ensure effective competition. Even though, as we're about to see, there is a huge problem of concentration of power in the hands of very few companies that really operate a lot more like an oligopoly rather than anything that is describable as competitive. How is the Financial Conduct Authority appointed? Well, the governing body is appointed by Her Majesty's Treasury, and there's also a seat for the Bank of England's Deputy Governor who sits there automatically. The Financial Conduct Authority operates by a rulebook called the FCA Handbook, and it is empowered to write rules for all regulated activities in great detail. Its main weapon is that it licenses actors in financial services. So under sections 19 to 22, there's a prohibition on anyone providing financial services without authority. So no person may carry on a regulated activity, it says, unless authorized or exempted by the Financial Conduct Authority if it relates to an investment, which is defined by a Treasury order. But what we're talking about mainly is selling or promoting shares, bonds, options, futures, derivatives, and so on. And to operate in the UK, you have to be fit and proper with a suitable business model. Okay, so that's the Financial Conduct Authority, and most of the rules in the handbook are going to concern pretty similar things to what we see in company law. So, the things on directors' duties like duty of care, duty to avoid conflicts of interest, duty to act for proper purposes, duties of disclosure. All of these things are within the rule-making power of the Financial Conduct Authority, and it can place obligations onto asset managers if it chooses to. Okay, next main group of actors are all the asset managers. And what this table shows in the slide is just an example of 6 big companies that we're going to look at in different sectors as we go through the course. HSBC, bank, BP, oil and gas, SSE, electricity and energy, Vodafone, telecoms, Sky, of course, media and internet, and Tesco, a supermarket providing food. When we look at the shareholders of these big firms that everybody knows, what we find is a pretty common list of shareholders that are essentially big investors. You see the same names popping up over and over and over again. So the first ones I want to draw your attention to are BlackRock, Vanguard, and State Street that we've already mentioned. And we've already said that in 2017, together they would have been the largest the largest shareholder if combined in 438 out of 500 S&P 500 companies. Now they're even bigger. So BlackRock holds $12 trillion in assets in 2025, Vanguard over 10 trillion, and State Street, the third one, which is being overtaken by Fidelity, over 5 trillion. So they have enormous shareholdings, and you can see again and again they are shareholders in all of the UK's biggest companies, including the ones here, some or all of them. If you look at how much of the market these three own together, in America, they own 25% of all voting shares in companies and 20% of all market capital in the US. In the UK, these three firms own 16.4%, or I should say they are the registered shareholders. So legal shareholders, they're not the real investors, but they control the shares of 16.4% of UK companies, 13% in Australia. When we look at the big asset managers in the UK, the ones that you see again and again on this list are Legal and General, you see Schroders, you see Aberdeen, you see Aviva, you see Standard Life, you see HSBC Global. So what we get is a picture of incredible concentration amongst individual shareholding. And when we look across the world, we can see that the big ones are getting bigger and bigger all the time. Here's just a list of top 50. The 4 that we've got there from the UK, you see BlackRock, Vanguard, and State Street is in numbers 1, 2, and 4. Fidelity Investments in the US is now moving into third position. This, by the way, is from 2024, this table. So BlackRock had 10 trillion just last year. Now it's 12 trillion. And similar with Vanguard. I mean, they have a lot more money this year in a very short space of time. The big ones that we see in the top 50 from the UK are Legal and General, we see Schroders, we see HSBC, and we see another Fidelity Investments, I beg your pardon, Fidelity company, which was originally linked to the US Fidelity Investments, but now there's the UK branch, which is called Fidelity International. Big asset managers are controlling an enormous amount of stocks. Now, why is it that in the US and the UK, we see a picture like this with really big asset managers and also actually quite large stock markets? Well, the main answer is that the US and the UK have minimum systems of state pension, of public pensions. So under the US Social Security Act, you pay in a certain amount of money over your lifetime, and what you get out of it at the end is not linked progressively to your income in the way, for instance, that it is in Germany or France, where the state pension aims to usually replace something like 2/3 of your pre-retirement income. Social Security in the US and the state pension in the UK is meant to be a sort of more flat minimum safety net system. So that means that more people have to save in occupational pension plans. Now, what this chart shows is sort of indirect evidence of this relationship, that stock markets get bigger when more people are saving through workplace pensions. And when stock markets get bigger, that means that there's more dispersion in who owns shares. So in countries where you have very small occupational workplace pension sectors and you've got very big income-linked state pensions, you get more block holding shareholders that own 20%, 40% of companies, and it's often usually old families that are very wealthy and have held on to very large stakes in companies. So this chart shows a correlation between, on the x-axis, public pension spending as a percentage of GDP. So going up, if you've got an income-linked state pension, the amount of spending as a percentage of GDP is going to be higher. It's going to be lower if you just got a minimum safety net pension system, like we see, for instance, with the UK there with the little plus sign, and the US there with the little orange X. And that also means that the number of block holders in the system goes down because there's more dispersed shareholding. Okay, so bottom line is the reason that we see big stock markets, lots and lots of pension money in the stock markets, and also this incredibly concentrated class of asset managers is a lot to do with the way that the state pension is organized. That doesn't mean that asset managers have to dominate, but it's one of the reasons why it's evolved in this way. And we see a different picture that we could talk about separately for how things work in Germany or France or Italy. Basically, they're the big financial institutions of banks rather than asset managers. Okay. Third point is what kind of duties these asset managers are under. And there's not really very much law that regulates them specifically. Okay, the FCA handbook might apply to them, but there haven't been that many rules, that many obligations imposed on asset managers. So, the basic starting point is trust law and what we see in trust law and how that applies to an asset manager. Barlow, Clowes, International and Vaughan is the most useful starting point. In 1991, the Court of Appeal accepted, it wasn't a point of dispute amongst the barristers in the case, that assets and monies held by Barlow Clowes, which is an asset manager, are trust monies held on trust for all or some of the would-be investors who paid money to Barlow Clowes International for investment, and they are not the general assets of BCI. So what it's saying there, which I think that we could draw a direct analogy with BlackRock or State Street or Legal & General or Schroders, is that when these asset managers are holding money on behalf of their clients, they are held on trust. That is by automatic operation of the law. And that's very simple. The settlor is the person. To analyze in trust law, it's very simple. The settlor is the person giving the money, the trustee is the person holding the money, and the beneficiary is often the same person as the settlor, in the same way that it happens in a pension fund. Can you contract out of these rules? That could be a big debate that we aren't going to go into, but basically the answer ought to be, well, the more powerful the institution, the more that rules usually become mandatory and not subject to freedom of contract. It's more suited when the parties have equal bargaining power. So next case, which shows something about investment duties that's useful for us, is Harries and the Church Commissioners. And this held that the Church of England Pension Fund could lawfully divest from apartheid South Africa, because the Church of England thought that regime was and apartheid was completely incompatible with Christian values. So although Harries complained, the High Court, Viscount Donald Nichols, held that it was entirely within the scope of the fiduciary's discretion to withhold investments from South Africa, even though there wasn't any express term of the trust. And so that is a pension case, but the same logic applies to any fiduciary, which would include asset managers too. And then there's the Palestine Solidarity case more recently in the Secretary of State for Housing, Communities and Local Government, which held that the fund's trustees can take account of ethical concerns if they're investing, so long as the ethical choices over investment would not involve a risk of significant financial detriment. So here the claim was over whether the local government pension scheme could divest from Israel. And the people in the local government pension scheme wanted to because of their objections to Israeli settlements in the West Bank, amongst many other things, and the violations of international law that this entailed. The government and the Secretary of State tried to write rules prohibiting the pension scheme from divesting and boycotting investments in Israel. But the Supreme Court held that this would be, on application of Palestine Solidarity, it would be ultra vires for the government to do so. But the most important thing here is that if you are a fiduciary, if you're investing, then you've got an unlimited scope of investment. You can invest as if you were an owner. The Trustee Act 2000 says this, but you are constrained by what would risk significant financial detriment. So you can't do anything that would risk significant financial detriment, but you can make, within those bounds, whatever ethical choices you like. The Trustee Act 2000 applies to all trustees, anyone in a position of trust, and says that there's the standard rules on duty of care. You've got to invest according to standard investment criteria, and this goes to something called modern portfolio theory. And that simply means that you've got to sufficiently diversify an asset portfolio, an investment portfolio, to decrease risk. That's modern portfolio theory in a nutshell. And basically, if you're investing in 20 shares, you probably got the value of a full index investment or 90% of a full index investment. If you invest in 100 shares, then it's 99% of risk reduction compared to a full index investment. So excluding certain investments based on ethical concerns, like concerns over states' abuse of human rights, war crimes, violations of international law, or concerns about fossil fuels, concerns about international labour standards being violated, anything that is compatible with the Christian religion in the case of the Church of England Pension Fund, is probably not going to violate this duty of risking significant financial detriment. Okay, so these duties are can all be opted out of under the Trustee Act 2000. Schedule 1, paragraph 7 says that, but that's for the ordinary trustee. For big trustees, those handling pension money, the exclusions are greatly tightened. So Section 34 of the Pensions Act and a number of other sections prevent the exclusion of duties of pension trustees. However, and this is the important point to highlight, if a pension fund delegates money to an asset manager, then their liability for breaches of duty become limited. It therefore becomes the asset manager's responsibility, not the pension trustee's responsibility. And that in itself is one of the big reasons or one of the big incentives to outsource investment management. By the way, entirely the same or very, very similar duties and limits to duties in the American legislation, ERISA, trustees, pension trustees, duties are limited if they outsource to asset managers. Okay, so how are asset managers subjected to responsibility from a governance viewpoint? I suppose it's important to note that these are usually just corporations. They have a board of directors. They have their own investors. Some, like Vanguard, are a bit different, organized as mutual funds. But they are essentially corporations. And the people who invest money through them don't usually have any say in their internal governance. As I say, Vanguard is somewhat different. But so that is a very significant gap. But what there is in the UK is something called the Stewardship Code 2020. So principle one says that asset managers should aim for long-term value of the clients and the beneficiaries that they're serving, which should lead to sustainable benefits for the economy, the environment and society. And principle six says that asset managers should report their voting policy, have guidelines to escalate if companies aren't taking their concerns into account, and explain how they have sought and received their clients' views and what they have communicated to clients. So Stewardship Code says that asset managers should listen to their clients and basically pursue their interests, but it doesn't give any legal powers to the clients of asset managers over what the asset managers do. The Stewardship Code is comply or explain, so you can opt out of it, but also contained within the Stewardship Codes, you don't have any real hard rules. So everything is left to market power, of which asset managers have a lot, and the typical client has very little. There was one attempt by pension trustees who are member nominated, we're going to talk about that in a second, called the Association of Member Nominated Trustees, in a document called Red Line Voting, started in 2016, new edition in 2021. To develop an environmental, social and governance voting policy for all the members of the AMNT. And that's an organisation which covers about, over £1 trillion worth of pension assets in the UK. So they said asset managers have to have standards on what they're doing on the environment, have an environmental committee, or tell companies to have an environmental committee on the board in order to do things like push for clean energy. It talked about having diversity on boards, making sure that the CEO wasn't paid too much in excess in their salary compared to the average worker. So have, I think it was originally a 1:20 maximum ratio. And recognise independent trade unions for the purpose of collecting bargaining, pay living wages to the lowest paid staff. But asset managers uniformly refused to follow, almost as if they were operating in a cartel. And there had been several reports over the last few years bouncing between the Financial Conduct Authority and the last government, but nothing has happened yet to make asset managers follow the voting policies that the elected representatives of the real investors actually wanted. Now, the FCA could do something about this. It could write rules. And if we look at trust law, we see a case like Button Kelson says pretty clearly, in the words of Lord Justice Romer, that the right of a beneficiary or beneficiaries if they're united is to compel trustees to use their voting power in the best interests of the trust estate. So, what that's saying is that beneficiaries can get together and tell trustees how voting rights that are held on trust should be used. So, to illustrate that in a concrete example, if you've got a pension fund which has outsourced money to an asset manager, and whether or not this is in a pooled fund, they are the solely entitled beneficiaries, and therefore, as a default rule in trust law, they have the right to instruct the use of voting power. But asset managers are completely refusing to follow any instructions, as I've said, and there hasn't been a court case yet to determine what asset managers have to do. The FCA could write rules, but it hasn't done so yet. Parliament could write rules about what asset managers have to do, but it hasn't done so yet. And this is really important because we see a big divergence in what asset managers want to do with all the voting rights that come from workers, usually who are saving for retirement, and what the real investors want. And in an article for the New York Times, Professor David Weber at Boston University put it pretty eloquently. He explains in an article called The Real Reason the Investor Class Hates Pensions, namely asset managers on Wall Street, like in the City of London, the reason why they hate big pensions is that they don't want to be told what to do. Asset managers quite enjoy having a great deal of money and the shareholder voting power that comes with it, and they don't want to give it to the people whose money is actually invested. So Professor Weber describes how asset managers have promoted tactics to smash and scatter pension funds, and this has been most viciously pursued in the United States, across many different states, trying to break up public pensions, trying to break down pensions that are defined benefit and collectively bargained in the private sector, to make sure as much as possible that everyone just has individual pension accounts, that big pension funds that might have some bargaining power to stand up to asset managers or give them instructions don't have that power anymore. But it's also about fees, because if you've got lots and lots of small pension funds or lots of individual savings accounts, and those small entities outsource the management of their money to much bigger entities, then the bigger entities are in a very good position to charge very high asset manager fees. So what this table shows very simply is some calculations with a few figures. Imagine you've got somebody earning £40,000 a year, a bit over the median wage in the UK, and they've got 40 years worth of savings, which is quite long, but just for the sake of example, and they're making 10% contributions to a pension fund each year. If they have zero fees, they would save about £300,000 if they have 3% returns per annum, compounded monthly. With 5% returns, £483,000, and with 8% returns, which would be quite high, just over £1 million compounded monthly. So you see the beauty of how much you can get with compound interest. Okay, so by the way, I should add that typical objective for stock market returns is 8%, and then assume 3% inflation or hopefully less, and you would end up with 5% returns. So now let's imagine that there's also an asset management fee applied to the savings that are being invested. Okay, so if you've got a 0% fee, let's just focus on the middle column, 5% returns, £483,000 roughly. If you have just a 0.5% asset management fee, then 12.3% of your pension savings by the time you hit retirement will have been taken in fees. An extraordinary amount for just a tiny 0.5% fee. If you go up to 2.5%, in asset management fees, nearly half of the pension is going to be taken away from fees, and everything in between it. So, very simply, if you've got big asset managers and their power is very concentrated and they're bargaining with very small investors saving for retirement, they can charge higher percentage fees, and this takes an enormous amount of wealth away from people saving for retirement and puts it in the pockets of Wall Street and the City of London. Okay, so now let's talk about pensions, what's happening on that side of the equation. So we mentioned the state pension before, and just worth noting, this is all organised on the Social Security Contributions and Benefits Act 1992. Currently, in 2025, the state pension is £230 a week, which translates into just under £12,000 a year. And that's with a full state pension, somebody who's saved with 35 years of national insurance contributions. Okay, so most people would see that £12,000 is not enough to live on in retirement, although many people actually have to live on this. And this is one of the biggest causes of old age pensioner poverty. So what most people should do and hopefully get in their workplace is an occupational pension to add on top of the flat minimum state pension. These were traditionally organised through collective bargaining. In fact, collective bargaining was one of the original inspirations for the state pension, or they could be set up by an employer. If it's organised as a trust or a corporation, the Pensions Act 2004 requires, under Section 241, that 1/3 of the pension trust or corporation board is elected by employees or the beneficiaries saving for retirement, or a third is chosen by the union. And the reason this rule was introduced It follows on from a slightly weaker rule originally in the Pensions Act 1995, is because of the concern about employers having too much control over pensions, over pension funds, and abusing their power. And there was a notorious scandal with Robert Maxwell, whose daughter you might have heard of, Ghislaine Maxwell, been in the news recently because of the Jeffrey Epstein abuse. So Robert Maxwell, her father, was the proprietor of a newspaper, and he took a lot of money from the company pension fund, transferred shares to his own slush fund to use to fund his lavish lifestyle. So that kind of abuse had to be stopped, and one of the ways in which Parliament sought to stop that abuse was to have elected representatives of the beneficiaries or union nominees on the pension fund board, at least 1/3. But there are exemptions for some kinds of pension funds. So if it's a multi-employer pension plan, then there's an exemption from this 1/3 requirement. Often multi-employer bargain plans have higher levels, but some, like the university superannuation scheme, have worse than 1/3 member-nominated representation. It's about a quarter at the USS scheme. And that leads to all sorts of problems in poor management because of a lack of oversight. Under Section 243, the Secretary of State can raise this threshold to 1/2, and it can get rid of loopholes. It can get rid of exemptions, like for multi-employer pension plans, if it wanted to. And Parliament could simply legislate as well. Also, this legislation specifically covers trust-based pension schemes and pension corporations. And what's been happening in the last particularly decade or two is that more and more contract pensions and insurance contract-based pensions have been set up, which purport to not have the rules applied to them. Now, it's very debatable if you've got a contract pension that it's not actually just a trust, because, of course, if somebody gives their money to an employer from their paycheck and there is a fund there, it doesn't matter if you call it a pension, it doesn't matter if you call it a contract-based pension, there is still a trust because there is the intent to create a trust. And arguably, if there are exclusion clauses, these would be void under legislation like the Unfair Contract Terms Act. But nothing's been done about it yet, and so these member-nominated trustee rules haven't been applied properly to contract and insurance-based pensions. Now, a lot of people, despite collective agreements, despite employers setting up pensions, simply didn't have any pension at all in their workplace. And to fill this gap, the Pensions Act 2008 was passed to set up a system called automatically enrolled pensions. And so this was designed to be a simple, defined contribution pension plan that everybody would be enrolled into unless they positively opted out. So Section 1 of the Pensions Act 2008 says everybody is entitled to be automatically enrolled if they're a worker in UK law. So that's anybody who personally performs work, not for a client or a customer. In other words, not a genuinely self-employed person. And so long as you're within a sort of generously defined working age, 16 to 75, then you're a job holder and you can be automatically enrolled. You have the right to opt out if you want to, but the participation is quite high. You've got to have a qualifying amount of earnings, £6,240, and it goes up to £50,270. The employer's contribution has to be at least 3%, and there has to be a total of at least 8%. So often workers are contributing 5% and the employer less. And in order to make sure that not too much money went to private asset manager fees, the government set up something called the National Employment Savings Trust, which is essentially a public option fund manager that tends to operate with very low fees, and it's run by the government. And now this is becoming very fast one of the biggest wealth funds in the world. So Nest now has 13 million members. It covers 1/3 of UK workers, and it takes money from around 1 million employers. In September 2024, it had £43 billion in assets under management. It's been projected that this will rise to 100 billion by 2040. I think that it'll probably be much higher than that by 2040. But the board has no worker representation, no member-nominated trustees. The board was originally appointed by the Secretary of State, and the current board appoints its own future successors under the way that the law currently operates under Schedule 1. The Secretary of State could change this at any time by applying the member-nominated trustee rules through Section 243 to Nest as well. Now, Nest as such would be much higher if the contribution rates were raised, and they probably do need to be, because think about how low the state pension is. This very, very basic workplace pension with just 8% contributions from workers' salaries is not really going to make up an adequate retirement income for most people. The other big fund which is publicly run is actually 86 different funds, the local government pension scheme. Different local authorities all have their own individual pension plans, but this LGPS logo is sort of like an umbrella term. The government has encouraged some councils to merge, but it's still pretty dispersed. And what that means is just they have very little bargaining power, and they can be charged very high fees. They also don't have a coherent governance structure. Some change was made by the Public Service Pensions Act 2013. Section 54C says that there's a board with equal employer and member representation, but this simply assists the scheme manager. It can't tell the scheme manager what should be done with all of that money from local government workers. And yes, if the schemes were all just merged into one big one, essentially a huge amount of money could be saved on administration costs, and a huge amount of money could be saved on asset management fees, because LGPS would be in a position to take investment management in-house. It wouldn't have to pay percentage fees at all. It could hire salaried investment managers, which don't take a percentage of everybody's retirement money at all. If we go over to Canada, the US, Netherlands, or Australia, we see the benefits of merging large funds into one another. In Canada, there's 8 big funds known as the Maple 8, command a huge amount of investment, and these are also some of the biggest investors in the UK. Long-term patient capital is what they have. They can have a voting strategy which matches what their members want, although lots of complications under Canadian law, which make it not so great either. The Committee of Workers' Capital is an organisation that pushes a lot of progressive ideas for Canadian pension funds, but that's for another time. You've got CalPERS, the California Public Employees Fund in America, CalSTRS, which is California Teachers, Federal Thrift. So you've got these big funds. They're organised. They have much more clout in the markets, and that is precisely what the UK government has been looking at recently, and I think is probably going to continue to. Okay, so next big player are the life insurance companies. So life insurance starts with an insurance contract, and it's usually a very simple contract that I pay you a certain amount of money in my insurance premiums. If I die at some point, then you pay me a sum that is fixed under the contract. If I reach retirement before I die, then often what I get out of the life insurance contract is an annuity. So life insurance often does exactly the same thing as a pension fund. There's a whole body of law, however, which is different for life insurance contracts, starting with the famous 1766 case of Carter and Bone, that in insurance contracts there's a duty of utmost good faith. But pretty similar to what we see in pension regulation, and in fact all securities market regulation. Utmost good faith defines what a lot of regulation in financial markets is about. So basic point is that life insurance contracts are almost identical in their functions to pension trusts, even though one is contract and the other is a trust. To give you an example of a case and how life insurance operates, we can look to a leading decision called Equitable Life Assurance Society and Hyman, decided in 2000 in the House of Lords. And so here, Equitable Life had life insurance policyholders of two different kinds. You had a group of guaranteed annuity rate holders, and there was a group of current annuity rate holders. And very simply, the difference between the two is that if you were a guaranteed annuity rate holder, you were guaranteed to get an annuity, a payment, which wouldn't change so much with what the stock markets were designed to do. So it was meant to be low risk. Current annuity rate holders, more risk, more exposed to the stock market. So they could get higher returns, but they might also lose money. And the guaranteed annuity rate holders were claiming that the directors of Equitable Life breached a duty in contract, an implied term, they said, to fulfill their reasonable expectations. Their reasonable expectations, said the guaranteed annuity rate holders, were defeated when the directors lowered the bonuses that were given to guaranteed annuity rate holders and used the money to pay current annuity rate holders, subsidize them when the current annuity rate policy holders lost money because the stock markets went down. So the House of Lords held that yes, the directors breached their duty, that they breached, I beg your pardon, an implied term in the contract to fulfill the parties' reasonable expectations. They shouldn't have subsidised the current annuity rate holders with the money that would have otherwise gone to bonus payments to the guaranteed annuity rate holders. Unfortunately, after this case was decided, Equitable Life went insolvent. So this illustrates how life insurance contracts worked, at least in summary. But I think it's also useful to see that through contract law, you can get exactly the same duties as we could develop out of company law or trust law. So Section 171 of the Companies Act says that directors have to act for proper purposes. And if this was being fought as a company law case, you would probably argue, you could argue lots of things, but you'd probably argue that Section 171 was applicable to the directors of Equitable Life using their powers for improper purposes. You can find exactly the same kind of duty under trust law. So, when we've got functionally equivalent kinds of financial product, then what the law should do is also have functionally equivalent solutions to problems. And there's no reason why that couldn't happen. No reason why that couldn't happen for duties. No reason why, therefore, it couldn't also happen for governance structures. And life insurance is much more common in continental Europe, as I mentioned, and you can see in the EU regulation, the Institutions for Occupational Retirement Provision Directive is designed to cover both life insurance and pensions, regardless of the way in which retirement savings are organised. Then we've got mutual funds. These are also known as collective investment schemes, mostly open-ended investment companies is the way that they're organised. And that means that anybody can buy into an open-ended investment company, get shares and redeem the shares. Unlike closed-end funds, which has a fixed number of shares to be sold, it can't be added to and subtracted. Under EU law, which has been incorporated into UK law, there's the Undertakings for Collective Investment in Transferable Securities Directives, also known as the UCITS directives. And this requires that collective investment schemes, what we can simply call mutual funds, are authorised by a regulator. In the UK, that regulator is the Financial Conduct Authority. And there are a few company law specific rules for these open-ended investment companies. Which is what a typical collective investment scheme is in the UK. Under Article 25, you need a minimum capital, you've got to have a safe depository, and you've got to disclose financial and performance information to clients. There's not very much about how these mutual funds should be run. Member states just have to have some rule under Article 19.3 on the exercise of unit holders' voting rights, but there's little else. You find more rules in the Shareholder Rights Directive from the EU, and of course, because it's a company, the Companies Act applies by default to all kinds of companies, including open-ended investment companies. But by the way, we often call these OICs, so OEIC is pronounced OICs. So under the 2001 regulations, there are some modifications to the General Companies Act rules. For instance, 10% of members can call an extraordinary general meeting under Regulation 34A. And under Regulation 39, there is a power of the general meeting to make a decision that binds the company. Usually that would be 75% with a special resolution. But the problem with this is that even though you have a lower threshold for all the people who invest in mutual funds to bind what the company does, they are going to have a very hard time in taking collective action, contacting each other, even if they can find the information of who everyone else is, in order to organise a vote. And so you have the typical costs of collective action. But mutual funds should be classified as trusts according to the Barlow-Clowes case, and therefore the people running them should have the same duties as in trust law, although on top of that, probably more usefully, there are all the duties in company law. So if we look at the whole UK market now, what we can see is that trust-based schemes make up the big majority of pension money. So there's 3 trillion in assets across the whole of the UK. Here is private sector defined benefit schemes. So there's usually collectively bargained ones that guarantee money in retirement. Here's public sector defined benefit schemes. This segment is trust-based defined contribution schemes. So that means that what you pay in is what you get out, and the employer doesn't guarantee any certain return in retirement, much more risky. But these segments here are all contract-based or individual personal pensions, maybe insurance contracts. Many of these will be in a regulatory void when it comes to governance standards, something that hasn't been addressed yet. Final group of people to talk about in investment management are the retail shareholders. So remember the charts with the blue line that goes down and down and down, individual investors? I mean, actually in the last few years, it's sort of stabilized. So if you want to go and buy shares in a company, you can do this traditionally by going to your high street bank. HSBC, Lloyds, NatWest, Barclays, whatever it is, most banks will have some kind of service for you to buy shares in the stock market if you wanted to. So high street firms usually do this. The problem is, from a governance perspective, is that these high street banks wouldn't usually allow you to exercise voting rights on shares very easily. Barclays says, for instance, in its 2015 agreement, there might be a more updated agreement now, but this is a useful example. If you ask us to vote as proxy for you, we may refuse. Or agree on payment of a fee. So in order to exercise shareholder voting rights as an individual investor, it might be hard. You might just be told no, or you have to pay money. Charges seem to violate pretty clearly what the FCA handbook says about this, but that doesn't mean that banks don't get away with it because it's just their standard form contract, and they will say, well, what are you going to do? You're going to sue us, and that would be very hard, very time-consuming, very costly. Now, all of this is changing in the last few years because of fintech apps. So there's lots and lots of different apps that you can download on your phone and you can buy shares with. Some you have to be very, very cautious because some are not actually investing in shares at all. They're investing in what you call contracts for difference, although they look like you're trading with shares, but you're not at all. But there are a number of apps which allow investment in shares. One of the really big ones that is growing and might be very significant soon is called Revolut. That allows you to buy shares through the app. It also allows banking, and they are currently applying for a full banking license in the UK. And this could combine what's already been happening quite a lot more in China, where people have their savings invested in shares. Kind of risky, but also possible to earn higher returns. In America, this is much more developed. If you buy shares through an app like Revolut, then you can vote on the shares. It's made very easy. It's been facilitated in the United States. Much harder in the UK because the regulatory structure is somewhat behind. Under the Dodd-Frank Act, I think it's worth adding that if you bought shares through your Main Street bank, then the Dodd-Frank Act, Section 957, abolished the right of Main Street banks who acted as what we call broker-dealers to vote on those shares without first taking instructions. So that would prevent, in the UK equivalent, something like Barclays voting on shares without your permission or instructions. And that was very important because these broker-dealers were swaying votes in highly contested cases in corporate governance, like, who's going to be on the board of Disney. So they banned broker-dealers voting without instructions from the person whose money it is. And very simply, that idea could be extended to all the asset managers and to make them not vote unless they are acting on instructions from the real investor in the way that they want to, or following a voting policy. And we already see legislation like that covering pretty much all big financial institutions in Switzerland. In Switzerland, it's banks rather than asset managers. But a law in 2013 requires just what we said. Banks have to follow voting policies of pension funds and are not allowed to vote otherwise. Okay, so final three thoughts for reform is that, one thing that the government could do is it could use powers to raise member-nominated trustees from 1/3 to 1/2, remove the loopholes for big multi-employer pensions to have the same number of member-nominated trustees as everyone. That would create more accountability, raise standards of governance, and you could extend that to Nest and LGPS as well. All capable of being done at the flick of a pen under Section 243. Second big thing that you could do to really improve pensions in the UK is you could encourage the merger or require the merger of big funds. LGPS would be easy to do because it's under government control. And the benefit of it would be very simply that people get more money in retirement because less money is sucked away by asset manager fees. And the third thing that you could do is that you could require asset managers to vote only according to the policies of elected representatives, like we see in Switzerland, and not vote otherwise. The Financial Conduct Authority could do this almost certainly through its rulemaking capacity, or it could be done by legislation from Parliament.